So we are talking about incorporated businesses, and a question I'm often asked is a salary or dividend best? How do I pay less tax? My answer might surprise you. In this video, I'm going to discuss the little known factors that you should consider when deciding how to pay yourself from your corporation. So a bit about dividends. A dividend is a type of payment shareholders of a corporation receive. You must own shares of an incorporated business to be paid dividends. Dividends do not reduce corporate taxes, and they do incur personal taxes. Yes, you pay taxes twice, but the personal taxes are at a reduced rate in recognition of the corporate taxes. This is called integration, and it's CRA's intention that taxes be approximately the same, no matter if income is received through dividends or a salary. It is a common myth that dividends are received tax-free. This is not the case and can cause some very shocked business owners when they look at their personal tax bill come tax time. So what are the main things you should know about dividends? Number one, they do incur personal taxes. Setting aside 20 to 30% of your dividend draws can help you be prepared. A client didn't end up doing this and did end up with a huge personal tax bill. When looking at their bank account, it was clear the money had long since been spent. Don't end up in this situation and set money aside for your taxes. Number two, they don't take advantage of childcare write-offs. This means they aren't a great option for parents of young children in daycare. A client of mine was spending $15,000 a year on childcare. This is normally a deduction on your personal income tax return, but because they had been taking dividends out of their corporation, they couldn't take advantage of these write-offs. Number three, they don't grow your RSP contribution room. This can really stifle retirement planning options down the road for small businesses. A client has been years growing a profitable business. They save for their retirement in their corporation and have been using dividend draws to pay for their living expenses. When they wanted to shift money into their personal name and close down their corporation for retirement, they had no way to take the money out of their corporation tax-free because their RSP contribution room limit didn't exist. A salary grows your RSP contribution room and can allow business owners to move large sums of money into their personal name, tax-free. Dividends don't grow your RSP contribution room, so you can't use this strategy. Number four, they don't contribute to your Canada pension plan. This means you aren't entitled to CPP when you retire and can leave you impoverished unless you save appropriately. It is the good intention of all of us to win the lottery, create the next big thing, and make it rich through real estate. Sadly, this leaves your retirement savings often neglected. I've seen many retirees with no savings and no Canada pension plan because they have been taking dividends out of their corporation. This can leave people destitute and is truly horrific later in life. Many older clients have been dismayed, disgruntled, and distraught by being unaware of these considerations when taking dividends out of their corporations. A bit about salaries. A salary is familiar to most Canadians because it results in a TFAR wage statement at the end of the year. Wages and salaries in a corporation reduce your corporate taxes, but you do pay slightly higher personal taxes. This is the CRA again employing the theory of integration. It's their intention that your income taxes be about the same no matter how your income is received. The differences between salary and wages often end up being only 1 or 2%. Because of this, I often encourage clients to consider other factors when deciding how to pay themselves. Deductibility of childcare costs, RSP contribution room, Canada pension plan contributions, and administrative requirements. Paying a salary involves a regular payroll calculation and monthly remittances to the CRA. This is a lot of work. It adds administrative tasks to your busy schedule and can cause significant penalties if you miss a deadline. To help overcome these administrative challenges, one client of mine found relief by using a payroll service provider to automatically make the remittances and T4 calculations. The last thing you may want to consider if you're a subcontractor is personal services business risk, or PSB. This can add thousands and thousands and thousands of dollars to your corporate tax bill. Wages are one of the best ways to reduce your PSB risk, so be sure to check out our other videos if you're a subcontractor. So which is right for you? Well, this is going to be different for every individual. My recommendations often depend on life stage, business stage, and retirement savings. So I often recommend younger clients go with the salary method. This gives you much more flexibility down the road in terms of childcare and RSPs. It also sets money aside in your Canada pension plan as a backup in case making it rich doesn't pan out. Now I eat my own cooking. RSPs and CPP are important to me, so I personally take a salary from my corporation. On the flip side, older clients or those who are very secure in their retirement plans might want to choose dividends. Childcare and RSPs may not be advantageous at this stage, and saving the $5,000 that CPP can cost every year is a nice perk to dividends, along with the reduced administration requirements. A third option, you can also consider a mix of these methods. A salary can give you structure for your personal finances while taking advantage of childcare and RSP contribution room and CPP benefits. Extra dividends can provide flexibility around cash draws when your business does well. All right, I've given you lots to think about today. I hope this video has illuminated the little known factors to consider when deciding between a salary and dividend. That's all I have for today. Bye for now.